Hey, welcome back, guys. It's Dan from Pekoe.ca. Today I'm chatting a little bit about self-employed borrowers. I've been self-employed for years and I found it always a challenge to get a mortgage. I want to share with you some options and strategies if you've been turned down by the bank or you're just not happy with the amount that you've been told you can afford and you're self-employed. Let's jump into that and talk a little bit about what's out there for you. Okay, so let's talk first about insured. There's insured mortgages, there's uninsured mortgages. Quick rundown: insured mortgages, less than 20% down. So when you're putting less than 20% down, we have to get the approval of CMHC, Genworth, or now it's called Sagen, and Canada Guarantee, one of those three insurers. And they're very strict on their guidelines as far as their debt ratios go. So even if a bank really likes you as a borrower, you still have to adhere to their guidelines, and they're very strict. Typically, banks are looking at your net income. So that's your line 15,000 on your NOA, your notice of assessment. And they're going to gross it up by a maximum of typically 15%. So I know you're thinking that's not a lot, and that's why I've found this video and I'm a little frustrated. Yes, you're right. Oftentimes, as entrepreneurs, we're writing down a lot of our income, and maybe that translates to a very low mortgage amount when you're going to the bank and looking to borrow. Well, the good news is there are some programs out there. Not all banks have access to the same insurers, but the last one I mentioned, Canada Guarantee, they do have a program called the Low Doc Advantage Program. This is a really interesting program, so I would encourage you to ask your bank, do they deal with Canada Guarantee, or do they have access to a program like this? And the program essentially states that what they're going to do is they're going to look at your line 15,000 on your NOA, so that's your net income, but they're going to look at your gross income for your business, and they look at reasonability. So they're going to find somewhere in the middle what is appropriate for your industry in order to determine whether or not you can afford a mortgage. And I find 9 out of 10 times you can afford a heck of a lot more than if you were to just simply go into a bank that doesn't have access to this program. So find out if that Low Doc Advantage program is available to you. And typically, I think it's probably about 10% of a down payment is required. But another cool thing is that they'll allow you to have some rental income. We can use that income to help bump up your affordability. And that's not just with the Canada Guarantee program, but that's also with the other insurers. Getting into conventional or uninsured mortgages, these are the mortgages that you got 20% down, or you're looking to take some equity out of your property. So refinance, those aren't insured. And in this case, the insurers are not involved, but the banks have a little bit more discretion. So they can increase your debt ratios a little bit, play around with that. But ultimately, it really comes down to, again, your line 15,000 and your net income, what's declared. But you have some other options here. Credit unions are a good option because credit unions have non-stress test mortgages. So they're not B20 compliant, meaning that we don't have to qualify you based off of that stress test rate. And oftentimes that'll increase your affordability or your overall mortgage amount. I guess the con for that is that the interest rate is going to be slightly higher for a non-stress test mortgage. The other option you can look at are alternative banks. So these are also called B banks, but B banks, essentially they have different ways of assessing your income. They have non-conforming programs and really interesting things out there to help you get into home ownership or to unlock some equity. They might look at something like bank statements. So they'll take a variety of bank statements, look at the deposits, and determine what is appropriate for your industry, gross it up annually, and come to a number for your affordability and use that income to help offset the debt we're looking at. Alternative lenders are really good with that. Typically it's bank statements, you'll need some invoices and some other stuff, but your broker or mortgage specialist will be able to help you out with that. And yeah, getting back to the rental income, that's a really important one too. So even with refinancing a property, if that property does have a secondary unit in it, we can use that rental income to help offset. So you would just add that to your base income and gross it up, and then we've got a higher amount that we can use to help offset that that mortgage. Okay, guys, those are a few strategies I have if you're self-employed. There's a ton more. I've helped self-employed entrepreneurs get into home ownership and get into the real estate game. So if you guys have questions, let me know. I'd love to hear your comments too. Let me know how you've managed this if you're self-employed, or some of the hurdles you've faced. And again, if you like this video, hit the like button. I'd love it if you could subscribe too. That helps me out. Until next time, I'll talk to you soon.